What is going on, traders? So the stock market sell-off continues. As I've talked about before and warned about, September 17th was the date that you guys should be on the lookout for. And lo and behold, it is playing out again this year. No, I'm not Nostradamus. No, I'm not clairvoyant. However, I do obsessively comb over the data that we have available to us and try to marry that with the technicals and my knowledge of the charts. So based on the data that we do have up until this point and my own technical analysis, I will try to determine when do I think the stock market will stop bleeding. Obviously, I'm not going to give you a specific date, but we're going to be looking at levels and certain market conditions, and I'll try to determine when do I think the stock market bleeding will stop, what is it going to take to avoid a full-on crash, and what you could do about your portfolios. If you watch my last video regarding the mid-September market downturn, the trend that exists, then you know that we opened up hedges in preparation for that or for that possibility. But I will get into all those details. You definitely want to stick around to the end of this video. So when do I think the pain will be over? Well, let us backtrack a little bit and look at what is going on in the markets. So here's the video that I did back on September 13th saying why if you have short-term positions, you should consider selling them on September 17th or shortly thereafter. Now, that was somewhat of a rather unpopular opinion based on some of the comments that I got, because around September 13th, we were still near all-time highs. However, based on the trend and the analysis, you can go back and watch this video. I don't want to rehash it, but here's a little bit of what I said. Basically, based on this data, if you have short-term positions that are up, you want to think of selling them on September 17th. Again, if you have long-term positions, I don't think it makes sense to take on that tax burden just for a month or two of savings, because you might be paying more in tax for selling your positions earlier than a year. So what I was talking about there was this disturbing short-term trend that we tend to see in mid-September. In this year would have been September 17th, or was September 17th. Obviously, this date changes depending on the year. But this was the date that there was the quadruple witching, which is basically the expiry of a whole bunch of futures and options, both index as well as individual. There were no more remaining catalysts besides the potential infrastructure bill. We were getting closer to the possibility of the Fed actually acting more hawkishly, tapering, potentially raising rates, although I don't think raising rates will happen at the end of this year. I do think they will do that next year. Most of the earnings have already been priced in. And if you take a look at the price earnings ratio of the S&P 500, we are nearing .com levels. So based on that, we opened up a hedge on the Qs, which is the ETF that tracks the Nasdaq. We're up over 50% on this. When I sent out this alert, it was 45%, but we ended up being actually closer to 60% up on the day. And we opened up another hedge on the Dow Jones. By the way, if you want access to all of our trades, link is in the description. I also send out actions on all of my hedges as well. Anyway, so when do I think the bleeding will stop? Well, we could see that the indices really breached some major levels here. We have the S&P on the left, the Nasdaq is on the middle, the Dow Jones is on the right. You can see the Dow Jones gap down below the 100-day moving average, the Nasdaq gap down below the 50-day moving average, and so did the S&P 500. However, this is what the interesting and honestly crazy thing is. We still are not in pullback territory. You could see these wicks. There was heavy buying into the close, or at least short covering into the close today, meaning that we did not even establish that official 5% drop from highs. So we are not officially in pullback territory yet. That is insane. We have not had a pullback in all of 2021 on the Dow Jones or the S&P 500. That is unheard of. By this time, we usually have an average of 3 in normal market circumstances. Obviously, everybody is waiting for the Fed on Wednesday. Now, we could see a relief rally on Tuesday from the time of this recording, meaning that this gap down here, we could see a possible relief where we have a flat day or even a green day the next day, waiting for the Fed to announce policy. Now, what happened today could actually influence what the Fed says on Wednesday, September 22nd. Maybe they were actually going to commit to tapering or even talking about raising the interest rates. However, after seeing the worst day basically in 2021 on some of the indices, they might rethink that strategy and remain rather dovish on Fed policy, meaning don't commit to tapering, push forward the interest rate discussion until 2022. It is very possible and plausible that today actually influence that what the Fed will talk about on Wednesday. Also, if you take a look at commodities, if you look at lumber, which absolutely crashed since April, if you take a look at iron ore, which has also crashed this month, even something like gold down to the $1,700 price range. What I'm trying to get at is that the Fed's narrative that inflation is, as a matter of fact, temporary, or the word that they like to use is transitory, that narrative is actually playing out. We do see a drop in prices all across the board, meaning that inflation was, as a matter of fact, temporary. Now, we still see some inflated prices in a few niche sectors like used cars, for instance. However, all across the board, we do see prices drop. So I don't think the Fed will rush to make any aggressive actions this week. Another potential negative catalyst is the debt ceiling. Now, I've been alive long enough to know that the conversations surrounding the debt ceiling are usually rather political, depending on who controls the House, who controls the Senate, etc., who's the president. However, they always end up working in favor of the country. I don't think that either party is going to really sabotage the longstanding credit rating of U.S. debt. And I do think the issue of the debt ceiling will actually be resolved favorably for the country and for the global economy. And then obviously we have the Evergrande fiasco in China. Now, this is why I think the Evergrande fiasco can be a major buying opportunity for the U.S. stocks. Now, I don't think Evergrande as a company is large enough to really affect the global markets for the long term. However, I do think the fears stemming from this and the potential domino effect stemming from this in the Chinese market could cause short-term negative ripple effects in the U.S. stock market. And we saw this actually in 2015. In 2015 and 2016, we had this double bottom pullback in the U.S. stock market as a result of the Chinese market tanking. So if this Evergrande situation does get worse and we see the Chinese market tank and the Chinese government does not step in, which there are a lot of mixed opinions on, and it adds to the market downturn that we're seeing here in the US, that could be a buying opportunity, or I will go as far as saying that will be a buying opportunity. So in conclusion, in my view, if the Fed doesn't come and save the day on Wednesday, then I do think that this stock market downturn will continue. We will eventually see a correction or a near correction. Remember, a correction is 10% of a drop or greater, but less than 20%, because greater than 20% would be a bear market. I mean, if you take a look at any stock right now, virtually any stock in any industry, there is nothing that is not overvalued. If you look at the value grades here, this is a rating on Seeking Alpha based on metrics such as price to sales, price to book. There are different ways of valuating a company. And what it does is compiles all of the grades of valuating a company, whether you're talking about EV over EBITDA, EV over sales. You can look into what, if you really want to nerd out, you can look into what each of these ratios, how they're calculated. But just know that this is how companies are traditionally valuated. So what Seeking Alpha does is it collects all of these different grades and gives it a grade. But if you look at any company right now, Roku, Nike, right, it gets a grade of F. If you look at Chipotle, for instance, gets a grade of F. If you look at Visa, it gets a grade of D- in terms of value. If you look at Snap, right, it gets a grade of F. Think of anything, even big tech companies like Microsoft. If you look at Microsoft, it gets a grade of D. If you look at Apple, for instance, Apple gets a grade of D-. Let's look at Facebook. I'm just randomly rattling off companies here. Look at Facebook. It gets a grade of D+, meaning that most companies are overvalued. And if you take a look at the S&P 500 price earnings ratio, this is for all of the companies that are in the S&P 500, we are nearing dot-com boom levels, meaning that companies right now are trading at insane valuations. Their prices are a lot higher than they are traditionally. So I'm inclined to say that, again, if the Fed doesn't come and artificially save the day, we will likely see a continued downturn. We could see the Nasdaq back at the 100-day moving average. We could see the S&P 500 near the 200-day moving average. Same thing with the Dow Jones. But that will be a buying opportunity. The reason that I wouldn't deploy so much cash right now is because of the valuations that I discussed, as well as some of the negative catalysts that are still in the books. Now, if you live in the US or a jurisdiction that basically taxes you heavier for short-term positions, for selling out of your positions, then obviously you'll be less inclined to sell your positions. For instance, if you bought Palantir for the long term just a few months ago and you sell it now for profits, you will pay a much higher tax than you would if you held it for a year or longer. So one of the things you could do is sell a covered call, which we already did on Palantir. If you bought Palantir, say at the $22 level, right now Palantir is near $27. Well, you can go in and sell the $28, $29, or $30 call on Palantir. you keep the money that you sold the call for. And if Palantir does not hit the strike price that you sold the call for, so say you sold the $30 call, if Palantir does not hit that $30 by your expiration date, you keep the money that you sold the call for. If it hits $30 and you get assigned, you'll be forced to sell Palantir at $30. Plus, you still get to keep the money that you sold the call for. This is called a covered call. And we go over this extensively in the private trading group. So selling covered calls is very lucrative here. Obviously, hedging using credit spreads or vertical debit spreads, also very lucrative here. But I also want you guys to keep something in mind. It's all about perspective, right? It's very important to keep perspective here. So right now, especially if you bought near the highs, you think what happened today and what happened over the last few days is an extremely drastic and violent move, right? However, where we are now, just think about this. This was the all-time high, like of all time since the stock market ever existed. Where we are now, this was the all-time high about a couple of months ago. So just think back 2 months when everyone was celebrating this all-time high. That's where we're at now. And right now, it seems like blood in the streets. And even when you look at this chart, the seasonal pattern chart, the one that I was referring to when I said that you might want to start getting out of your short-term positions on September 17th, even here, right? If you closed your laptop on average, if you closed your laptop and didn't look at your positions until November or December, you'd be higher than where you are today. So while you're in it, it seems like a world of pain, but we will eventually crawl out of it. The US stock market always does. As a matter of fact, this is what the yearly Dow Jones chart looks like. So be patient, focus on buying the dips on quality companies. Use this as a potential opportunity to rotate out of some of your shit stocks into more quality stocks. You want a solid portfolio distribution over the long term. And if you're itching to trade the short term, that is what options are for. Learn how to trade options. Come be a part of our group. Obviously, you can learn for free online as well, but it's great to be a part of a community, and we'd love to have you. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of the current market conditions, what stocks you are looking at as well. I love to hear from you guys. I try to respond to each and every comment. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.